Hello, welcome everyone. I'm Caroline, the founder and CEO of 15 Tech. We have built the 15 Tech online community to support women in tech in their journey. We know that female entrepreneurs get a dismal of 2.7% of all venture capital. And one of our mission at 15 Tech is to give them the code to master the fundraising process and make the investors aware of the unconscious biases that make them miss out on opportunities. One of our ambitions on the platform is to help investors easily diversify their deal flow, and soon they will have a direct access to a qualified pipeline of women-led startups who are raising funds in Europe, matching their criteria. Everything will be really easier. I know there is a lot of male entrepreneurs in the room today. You are welcome. Don't worry, we are very inclusive. We are trying to drive the change in the tech industry, and we need you as allies. Diversity and inclusion is not an option anymore. So please don't forget it for your board and your team. So now you are in our community and you can participate and share your idea about that and really talk about best practices and reach out specialists on the topic. This is our third session, online session, and we have received a lot of positive feedback and suggestions. One of the trending topics is about fundraising during this uncertain time, the topic of today. Some founders have reported postpone or cancel closing or bad behaviors, such as trying to halt valuations on the day of the completion. That's insane. So please, you can tell us in the chat your name, your company name, your country, and your funding stage, and perhaps if you are in a situation like that. That's important for us to know exactly the audience, but that's not the case of all VCs. And we wanted to offer you the investor's perspective to tell us honestly about their state of mind. That's why I'm very glad to welcome today Laura Connell, Principal at Balderton Capital. Please, Laura, please introduce yourself. Hi.
Hi everyone, I'm really pleased to be here with you today, well here so to speak, and been very excited to work with Caroline and 15 Tech on several initiatives. You know, now more than ever is a time to make sure that we're getting everyone into the conversation. So to give you a bit of background about myself, for those of you who are less familiar with Balderton Capital, Balderton is a venture fund that's been investing in Europe for over 20 years now. We've historically really focused on the early stage. So that's kind of Series A with some opportunistic seed and slightly later stage investing. I in fact focus a lot on our kind of Series B and later investing, but I'm also involved with fundraising and the investment committee at the early stage. And so I really wanted to be part of the discussion today with you to share some of the things that we're seeing. Obviously, you know, it's a highly stressful time for many of you. You know, I'm keen to share some of the tips that we've been working with our founders kind of very closely on. So yeah.
Perfect. So I will give you just a little bit of rules about this session. You can ask your question anytime through the Q&A tool. Please do not ask your question in the chat. It will be easier for me to pick your question. I will start to let you the time to ask a lot of questions. You can normally upvote inside this Q&A tool. If you really like this question, you have the same question, don't ask the question again, just vote the question. We will pause to ask your question during or at the end of the conversation. So Gail, my co-founder, and Ilaria, our community manager, are here to help you if you have any problem or any question in the chat. And so now we are ready to start. So Laura, what do you think of the current economic situation, and what is the state of mind of VCs nowadays? Are they still investing?
Yeah, so I think on the current economic situation first, you know, I started my career in the midst of the financial crisis in 2008, 2009. So you know, I'm kind of familiar with downturns, and in fact, many of people on the team have been through several already themselves. You know, I think what's interesting about this particular environment, and I use the word interesting as, you know, liberally, but what's interesting is that this is obviously a very unique type of shock. It's both kind of supply side shock, and as a second order effect, there will be, of course, demand side shocks. But with that kind of shock, there's also, I think internally we believe that there should be the opportunity to bounce back. Now, the main issue here is that, and none of us have 2020 vision, but that the amount of information that we currently have is fairly limited, i.e. the range of outcomes over the next 12 months is still very, very broad. We're already seeing a significant economic downturn in most of the more developed economies, but whether or not recovery comes, the bounce back comes back in the next 3 months, 6 months, or 12 months, I think that's still unclear. But what we do know is that with every week that goes by, there's an incrementally larger amount of information that allows us to narrow the range of potential outcomes. And so, I think in even 2 to 3 weeks time, we'll have a lot more information about where we're going. And I think what's been really heartening to see is that the speed at which governments have responded to this, particularly on the financing side for the early stage businesses that they obviously see within their own economies, has been very fast. So I think that there's more to do there, but I think hopefully we'll have a lot more information to help us make our decisions in the next couple of weeks and months. And secondly, I think we're very heartened by government response. And so to answer your second question, which is how are we thinking about that internally, I think, for us, we are open for business. I think so much of the approach that VCs take currently will be dictated by where they are in their investment and kind of fund life cycle, and the kind of VCs they are. So what I mean by that is, obviously, if you're a venture fund that is coming toward the end of, or the back end of your fund, and likely you need to think very proactively about future financing needs for some of your existing companies, it may be that you kind of over-index or reallocate your thinking and time towards support. We're all doing this, by the way, but in terms of time and financing towards your existing portfolio companies. Whereas if obviously you've just raised a larger fund, or if you're halfway through a fund, then you'll have more flexibility. I think the second point I was going to make is that obviously there are different types of venture funds. It's probably sensible to assume that those funds that are part of larger entities that have very liquid portfolios as well as illiquid portfolios, i.e. who also manage listed assets, will be feeling the hit, obviously, and so may well choose not to continue to invest as actively in the more liquid parts of their portfolios as they do in the kind of the listed portfolio.
Yeah, perhaps you can give us a framework to help funders to find these VCs really still active.
Yeah.
What kind of questions do you need to ask right now when you are talking? So I think you can give us some advice about that.
Sure. So I think when you're kind of putting your list together, your priority list, I would absolutely start by looking at whether or not, where every VC that you're talking to has, when did they last raise? What are their total assets under management at this point? It's hard to do, obviously, because you don't have perfect information here, but how much can you get a sense of how much of that fund might be invested? Often if you look at interviews that VCs do, they'll share what their average ticket size is. You can look up online, or indeed in the kind of historical news, what the latest investments are. That should start to give you a sense of, how much they've invested, of the kind of the total fund and assets under management they have. So I think that's very important. And I think also, try to establish who might be a standalone fund versus who might be a corporate venture fund. I think obviously there are lots of corporate venture funds that are in good shape and will continue to invest, but others, as I mentioned, who may be part of very large corporates who are either publicly listed themselves and may have taken a hit, so I would double check that, or indeed are actively investing in other types of more liquid assets, and who may also feel the burn a little bit more there.
One of the, I think it's the most difficult things now, it's like we have to make like some virtual pitch, term sheet negotiation in remote. That's hard enough when you are like face to face. Is that really possible during this lockdown? And once again, if you have any advice to give to funders, because I personally pitched for investors on Zoom yesterday, and I can attest that it was really challenging. It was okay, but I think it's challenging because you are not perceiving the same things. It's really harder.
Yeah, no, absolutely. Look, I mean, I think obviously we'd have all investors and indeed all founders have a preference for getting to know the people they're going to be working with in person. So it is obviously harder, but we are making investments over Zoom. I mean, we haven't announced them, but we've made several over the last couple of weeks. I will hopefully be closing an investment in the next week as well, and 100% of those conversations have been done over Zoom and by phone. So it absolutely is happening for those VCs that are still investing and have some of the criteria, meet some of the criteria I was describing before. That is happening now. I think what is certainly true is that the purchasing decisions, as it were, the investment decisions will probably be slightly slower. People will want to take longer, and it will be a little bit more of an iterative process just to make sure that you've built a relationship over Zoom, which is hard, but that will probably be true. And I think just a few tips about how you run a kind of Zoom pitch, as it were. Maybe this is a good point to segue, but so much of early stage investing is about building the relationship and really understanding the founder, both motivations and capacity to execute, etc. So a lot of it, and I think often founders may underestimate this, almost 50% at least of an investment decision is you. And so all the kind of opportunities you get at the beginning of a call, for instance, to give people a sense of who you are personally, that chit chat that can sometimes feel, some people will feel it's artificial, but it is really important to kind of have that conversation. How are you? Where are you right now? How have you been impacted? I think that's a really important rapport to kind of make sure you build before you jump straight into your presentation and your pitch. And the other thing about pitching, and I get this, it can be quite unnerving to have 4 or 5 other people on the other end of Zoom who are all kind of examining your deck and examining you, and who aren't necessarily giving you the kind of non-verbal feedback that can really help when you're pitching. Give people at the beginning of your pitch an opportunity to tell you whether they would like to ask questions as they're going. So make sure you keep stopping, because obviously it's going to be harder for you to tell over Zoom whether or not people want to ask questions, etc. But just make sure that you're finding the right ways to engage over Zoom. So pause regularly, solicit questions, give people time to kind of interject and have a conversation. It is all harder over Zoom, but it's doable.
I will just tell to Tatiana Zeller, I saw your hand. The rules here is to ask your question in the Q&A tool. Please do it in the tool. It will be easier for me to pick your question. We are 75 people here. So please ask your question. Tatiana, please do it in the Q&A tool. It will be easier for everyone. Okay, and I will take your question right after you you have done your message. We are hearing a lot about investors focusing on camel startups. So it's come from Silicon Valley. They love like new terms. So I said about camels. What does that mean? And are investors only investing now in this new kind of startup?
Yeah, so I think that term is really coined to describe those startups that investors, or indeed people, think can weather the storm, have enough by way of cash and either cash or really a business model that will be resilient in this kind of environment. So the short answer is, obviously, it is only fair to assume that in this environment, all investors, and indeed everyone, all founders, are going to be very focused on how best to maintain capital efficiency. Of course, there are some models that lend themselves better to that than others. But, I think what's clear is that there are still fantastic businesses being created across all sectors. But it is true, it has to be necessarily that, given the uncertainty we have currently in the environment, people are going to be a lot more focused on how you think generally about capital efficiency. So that's the short answer. But there are lots of businesses that, and it will only be coming out in the press in the next, continue to come out in the press, that are being funded, whether or not they fit the kind of strict definition of, being a camel or not.
Yeah. We have a question from Janet. How sympathetic will VCs be to startups who have had their lead terms reneged by their lead investors?
Yeah. I mean, super sympathetic, more than sympathetic. We've had several situations in our own portfolio recently where, you know, people have literally pulled a term sheet at the 12th hour. And, you know, it's incredibly hard for a founder to deal with that level of uncertainty when, you know, it's hard enough going through a fundraising process without worrying about people pulling a term sheet. You know, what I will say about that, therefore, is that don't close any of your options down before you have a term sheet in hand. You know, I think if you're already in a process, make sure that you're maximizing the number of conversations. Do not shut any doors until that term sheet is in hand, frankly, until the cash is in the bank. And I think if you are thinking about starting fundraising in, you know, a month or 2 months' time, I would get on that process sooner. If there were people that you were speaking to that you may have been stonewalling slightly because you weren't ready to start a fundraising process, I would start that conversation now. For all the reasons that we talked about, you know, these things will take longer. Even when the outcome is positive, these things will just take longer. Yeah.
We have a question from Jamie Brown. Laura, there is a lot of talk about, sorry, the question was like, there's a lot of talk around now being the perfect time to be building, but yep. What is Balderton view, and how will you best structure a pitch raise pre-engineering team hire, especially in the context of this new environment? Are you seeing the question?
No, let me just open up so I can have a read of it myself. Oh, hold on. Sorry, bear with me. Sorry, so was this more kind of team building exercise or team building question, or? Sorry, I can't see it.
The first one from Jamie Brown in the Q&A tool.
Yeah.
It's like, are you seeing the question? It's the first one.
No, for some reason. Oh, hold on. Oh, yes, got it. Okay, yeah. Thanks. Yeah, I'm with you.
Product build, MVP down. Okay.
Yeah, look, I mean, absolutely. Like, I think that is, Jamie, that is absolutely one of the things that I think is going to be really positive about this environment. There are going to be lots of opportunities to hire some really fantastic talent, you know, and I will say this, this is talking with my kind of silver lining hat on. Obviously it's going to be very difficult because, and many of you will have done this already, or will know people who are going through this, either who have been laid off already or who are being furloughed. Now, you know, we saw this in 2008, 2009. These kind of environments can be a really fantastic opportunity for those businesses that have good products, have the right vision, are prepared to make the you know, kind of difficult decisions on execution. It is a good opportunity to pick up really incredible talent, and you know, so what we would call kind of a combinatory opportunity for new people to work together and find each other in this environment. You know, I think what's so interesting about it is if you look at the 2008-2009 crisis, there are some absolutely fantastic tech businesses, forged in crises, essentially. I mean, Tesla, and I was talking about this with Caroline yesterday, Tesla went public, you know, around that time and has grown obviously astronomically since. Twitter, where there were some fantastic investments made and businesses that were really kind of built on times of difficulty. And, you know, so I think that if you were going to look at this, the kind of positive opportunities here, there is a way to capitalize on some of the disruption. You know, the second order effect of this disruption, of course, is that lots of the incumbents, the larger players that you may be looking to kind of dislodge, as it were, as startups, will be finding it also very difficult. A lot of their clients will be looking for opportunities to engage with new parties, more capital efficient parties as well. So, you know, there's always there can be an opportunity as well. I don't want to put too fine a silver lining on it because it's obviously going to be a very difficult time for a lot of people, but you know, there are opportunities like that, Jamie, that you can build on. Yeah, for sure.
Okay. Oh, it's me. Oh, super. It's strange. It's okay. So we have a question from Tatiana, also about an MVP fundraising process, and she's asking for a recommendation. You are an EV tech startup in Rhône, raising its board pre-revenue halfway through building our EVP, looking for 500,000 in seed funding. Where would you recommend? Sorry, the question are really. are moving really fast, really. So I don't know why, but it's okay. So where will you recommend going and talking to, Laura?
Yeah, look, I mean, maybe it'd be helpful for me to share a list of that people have been putting together. And I don't know if any of you have seen this, but there's a list circulating of seed funds, early stage funds that have said they're still active. So, you know, it is not the case that everyone has suddenly decided to stop investing and hold the trigger. Any of the seed funds that you would have considered reaching out to, you should still reach out to for the most part. Go through the exercise that I described at the beginning, but you should certainly be having those conversations now. So the typical investment process there will be, you should reach out to those funds several times probably. Remember that those people on the other end are going to have incrementally larger, fuller inboxes, not only from new in-mail, but you know, from existing portfolio companies. So just press ahead, be relentless in trying to get hold of people. You know, there are funds still investing, absolutely. And I separately, I'll share the list of funds that, if you haven't seen it, and might be useful for everyone as a resource, who are still investing.
Yeah. I don't know what is this sound in my computer, but it's like terrible. I don't know. So Yassine, now, interesting question about the metrics, KPIs or MRR for Series A. What is the typical investment process, please?
Yeah, so I mean, MRR obviously is relevant for those businesses that have recurring revenue. Yeah, it is. Those are kind of basic. That would be a basic KPI for you know, software and SaaS, for instance. I mean, again, these are what we're very conscious of in this environment is that you know, the kind of KPIs that we would otherwise be expecting may well be, or the level that we would expect people to reach the next 12 months may be somewhat harder. And I think this is what the question is getting at, probably. But you know, I think when you're talking to investors in this environment, you should use all the kind of anything around, you know, traction, early traction that you've seen. So that can be, you know, your user base, subscription, MRR, whatever, you know, client numbers, whatever it is that can help indicate some level of engagement and traction with an existing kind of user base will be critical. You know, I think that getting back to what I think maybe that question is really getting at is, you know, what do you think investors want to hear that you can get to in the next 12 months? Obviously, it's going to be a much harder environment to predict, to set your forecasts. And I think investors are going to be very aware of that. So I think in terms of the way you discuss your KPIs, in particular your forecasting, you know, you should be very open about those spaces you have a little bit more uncertainty about, and, you know, those things that you think are kind of definitely achievable. But I wouldn't, you know, I think you've got to, investors recognize that likely will have to be a little bit more, you know, what's the right word? Scenario based when we think about how you can get to the kind of core KPIs and the kind of performance we would usually expect at Series A. Yeah,
Laura, we were talking about that, the mental shifts that founders have to do right now, and perhaps adapt their pitch. Perhaps you can develop a little bit about that. How they need to switch their brain, how to pick opportunity, what they have to focus on, and perhaps the alternative.
Yeah, I mean, I think it's a really weird exercise for a lot of people, to be, investors included, to be going through at the very early stage, because the whole business really is based on talking about the best possible outcome, right? That's usually the thought experiment that we go through at the early stage. You know, what does this look like if everything goes to plan? And I think in this environment, somewhat counterintuitively, we're now having to ask ourselves, investors and founders alike, well, what happens actually if the worst possible scenario happens? You know, how does this business do in a scenario which is not the best case scenario of the next 12 to 18 months? And I think that's going to be a lot more a part of the discussion for everyone at the early stage than it would have been otherwise. But so to really kind of home in on that, the point is not to have a perfectly formed answer to that question. You know, the point is to demonstrate that you understand the first and second order effects of the environment. And I'll come back to that point in a second, but that you are being responsive to your environment, that you are kind of focused on execution in a difficult environment. You know, it's more those proof points that investors are looking for, rather than this kind of perfectly fully formed, you know, I think that X, Y, and Z will happen under these 3 or 4 different scenarios. You know, we know that you don't have 20/20 vision. So you know, that's the first thing about it. And coming back to, therefore, the kind of discussion that investors want to have, most likely it's, and we're having them, I'm having them at the moment with several fantastic businesses and founders. You know, it's okay, so what do you think the first order effects are for your business? You know, and for some it will be very positive. You know, if you're a gaming business or you're social or anything to do with streaming right now, you're likely, there's a very strong tailwind. But you know, for many other businesses, it will be very difficult. So first order effects, you know, what does it mean for your supply chain? You know, what do you think it means for your sales cycles? What do you think it means for any kind of disruption to your business's usual plan? You know, how do you think it will impact your capacity to maintain your installed user base, as it were? The second order effects are those that will kind of probably manifest at 3 or 4 or 5 months out. You know, what do you think? How do you think this will feed into demand, consumer demand, in the next, you know, 4 or 5 months? And to make that concrete, perhaps I can give an example of a conversation I've been having with a brilliant founder and team behind an e-commerce business. And this will be true for a lot of consumer goods businesses, but you know, the first order effect is that, particularly say if you're in an affordable category, that people are going to be at home and that they want to treat themselves, for instance, be it cosmetics, which usually does well in this kind of environment, or you know, other types of affordable consumer goods. So that maybe you'll see actually very little, maybe you'll have seen very little change in the last month. But actually, you know, if you drill down into your consumer base, for instance, and you figure out that maybe half of your consumer base are part-time employees, and the remainder are maybe, you know, full-time employees, but whose average income is below a given amount, you know, it's likely that on a 3 to 6 month basis, if we're still in this lockdown, if we're still in the situation of, you know, economic difficulty as a whole, it's likely that over time you'll see kind of consumer demand decrease significantly, and obviously the magnitude of that decrease will depend on kind of disposable incomes, etc., and the underlying client base. So when you think about having the conversation with investors, you know, it's not necessarily that you've got the full answer, it's just that you're starting to think very strategically about what the first and second order effects might be for you as a business, and how you can start to counteract those.
So we have another question, but I think you quite say about it. What is the minimum run rate should startup target in this time? And would you recommend they scale down or cut cost to meet this target?
Yeah, I mean, I think the advice that we're giving our founders is that, and the people, many of the teams we work with, is you know, you should be solving for at the very least, you know, 6 to 12 months runway in this environment. And you know, it is better to take decisive action now than it is to find, you know, to try to again forecast the future on a near-term basis and not make the difficult decisions today. And you don't want to be doing a kind of partial exercise now, finding that your burn stayed too high, and then in 3 months having to go through another very difficult period. That may happen in any case, but you know, I think we advocate for decisive action now. And you know, the key thing to say about that is that it is not just a question of laying people off, you know, I think, or furloughing people. That may be relevant for you. I think a lot of early teams obviously run very lean, but I think if I would go through the exercise, and we've been doing it with a lot of our founders, of looking at every line in your P&L, every outgoing expenditure, and double clicking on that, be it salaries, but be it also marketing, and really assessing whether or not that, you know, you're being as efficient as possible in your marketing spend. So to be clear about that, for instance, you might find actually that you're spending on one channel marketing that has actually got a hell of a lot more efficient, as a lot of offline players have pulled back on their marketing spend. So, you know, actually you can get a lot more of a bang for your buck, as it were, and you may find that you can cut spending without kind of massively impacting, you know, your outreach, as it were. So, you know, it's just being systematic about going through every line, and understanding, you know, just, it's not just a question of cutting, but is it a question of reallocation, and etc.
Yeah. Another question, totally different now, Laura. How do you think the M&A market is impacted now?
Yeah, I mean, I think the exit exits as a whole, be it, and actually an IPO, really speaking, it's not a liquidity event, but exits as a whole, be it IPOs or M&A, are obviously going to be impacted. I think M&A in particular for those kind of natural buyers, or larger corporates who usually are kind of very active. I think a lot of them are going to be holding fire. You know, the dry powder is there, but they will almost certainly be holding fire. We've already seen it. There's been a real slowdown in the M&A market now. So, you know, I think what's interesting about that, and one of the questions I've talked about a little bit before on webinars is, you know, given that the market it's kind of come off in the way that it has, and we will therefore see a slowdown in M&A, likely see a slowdown in IPOs also, because it's just, you know, it's not good timing. So you'd rather hold off for a while and see, you know, and kind of and see what happens. It's likely that those investors that will hold off fire incrementally, to an incrementally larger extent, will be slightly more mature investors. So like much later stage investors that really do need to believe that there is a possible exit on a kind of near-term basis, or at least a kind of medium-term basis. In some ways, I think the early stage may be more insulated than, as in terms of just the pace of investment, than I think this kind of later stage may be. So we'll see what happens. Yeah.
Thank you, Laura. A question from Kane Harrison. Do you have a list of requirements for startup at seed? What revenue are you looking for D2C? What the number of customers? A lot of questions in one. What would be an average investment amount at seed? And what is the amount of equity would you look to acquire?
Yeah, so I think, I mean, to be clear, Kane, thanks for the question. We do, and I did mention that we did some seed opportunistically, but we do mostly do, in fact, you know, really focus on Series A and onwards. So it's fairly unusual for us as a fund to do seed investing. But, you know, I think more generally, what I can certainly do after the call also is to share a little bit more information about some of the investors I know, seed investors I know, and how they think about things, if that's helpful. You know, I think particularly for D2C, it's not necessarily the sheer number of customers as much as it is the kind of engagement, anything about kind of expenditures that you're seeing per customer, and etc. So I think there isn't, particularly at seed, because so often you know, you just don't have the proof points at that stage. I think it's as much about kind of the story, where the product's at, etc., as it is about the kind of traction that you're seeing, the numbers you're seeing.
Okay. Another question from Isabel. So what are your thoughts about pre-revenue health tech investments with therapeutic solutions that need for regulatory approvals at the moment, when most non-COVID clinical trials and even therapeutic treatments are on hold until after the crisis? So it's an health tech startup, pre-revenue, still doing non-COVID clinical trials.
Okay, so I'm just going to try and get to the heart of that question, Isabel. Thanks for that. So I think, what are my thoughts? Well, I think the first thing to say about health tech investments that need regulatory approval, in particular kind of therapeutics, and I can't tell if you mean digital therapeutics or if you mean, I assume you mean digital therapeutics, but so I think, you know, we've made several investments in this space. I think, if I understand your question, it may be you're implying therefore that you're not going to get kind of regulatory approval at the same pace as would otherwise have been expected given the environment. You know, I think that will certainly be a pause for thought for investors. Not least because in this category, if you do require regulatory approval, it's probably one of the single most important proof points, right, for your product. So, you know, I think it may just take longer. I mean, it will take longer to get that proof point, and I think you know, investors, particularly those who may be less familiar with the space, will need a lot more hand holding. So, you know, I think as with all these you know, I mentioned the kind of purchasing decisions will be slower, and for simpler businesses, for, you know, the incrementally more complex the business is, the likelier it will be that it takes incrementally longer. But, you know, I mean, it's a hard question to answer. I hope I'm kind of trying to give you my best answer here, but it will probably take longer, and I think it's going to be hard if you really don't think that regulatory approval will come through at the pace at which you thought, and you don't have any visibility on when that will happen. It's obviously going to be a bit harder. But just on these kind of businesses generally, though, you know, when you're looking for the right kind of investors, you know, be aware that as a category, many VCs who don't have the in-house expertise don't look at this kind of, you know, digital therapeutics or this kind of business generally. And so when you're trying to solve for investors who would be interested in this at all in a good time, that is not even in this environment, you know, make sure that you're going through and checking their portfolio and whether or not they've actively invested in this space before, because that will save you a lot of time. You know, those investors who are familiar with therapeutics and digital therapeutics will be faster to understand the regulatory constraints, etc.
Okay, Laura, we have a question from Sarah. So I will not ask the second part of the question because you already answered about the metrics and KPIs. How do you build best, how do you best build a relationship with VC in the current economic climate? What works well?
Yeah, I mean, look, I think we are carrying on. We are having all our kind of initial conversations. You know, I think the best thing to do is to essentially adopt exactly the same approach that you would have done, you know, email outreach, however you can. Obviously, there aren't going to be as many opportunities to meet people at larger events, but, you know, send emails, try to set up the calls if you can. You know, we are all still looking to work with great founders. But it does mean that, you know, when you're having the conversation for the first time, for instance, over Zoom, which is obviously much less personal, you know, try to make it more personal without it being artificial, but, you know, introduce yourself fully. Feel free to share more information about you and where you are, and engage on kind of that from that perspective, as well as, you know, jumping into what it is you're working on.
Another question from Janet, and we talked about that yesterday. Do you have a view on venture debt in the market? So it's a question about debt versus equity. So sorry, the question just, it's quite
yeah,
hard.
I've got it.
Both, okay. So it could be like an option this time?
Yeah, so sure, absolutely. And I think absolutely it should be part of the arsenal that founders consider. You know, I think the best way to kind of approach that question maybe is to talk a little bit about the different sources of debt available today. Obviously, governments have made kind of loans available at kind of an unprecedented scale, and then alongside that, you've got the more traditional venture debt providers, be it the kind of SVBs of the world, or the Silicon Valley banks, or, you know, the Creoses and Triple Points that are kind of more traditional venture debt funds. You know, so I think absolutely you should be thinking about debt. I think a couple of parameters when thinking about it, venture, and this is, and I will start by talking about venture debt in the traditional sense, not the loans that have been made available by government, etc. Traditionally, when we think about venture debt, these, you know, we would encourage founders to consider it when they're at a slightly later stage, for a few different reasons. Things that are good about it are that it's non-dilutive, that, you know, it can be a nice, it can give you that additional cash buffer without, you know, and by non-dilutive, you know, when you think about where debt sits in your preference stack, you know, it is not equity, so they don't have a percentage ownership in the business, you know, for those who aren't as familiar. But what it does mean is that debt will sit in your cap structure above any equity, meaning in a liquidation event, for instance, debt providers have to get paid out first. And so to your point, Jenna, it's absolutely, you know, the kind of the comparison of 1 times liq pref on equity versus debt is the right one, because that debt is going to sit above whoever the equity investor is, whatever that capital is. And so any equity investor is going to want to understand, A, how much of debt there is, B, the business's capacity to service that debt, right, to service the interest rate. And I think, you know, that's partly why, coming back to my initial point, we usually see this at a slightly later stage when businesses have a little bit more visibility on revenues, meaning that they have a lot more confidence that they can service the debt, and when, you know, the valuation of the business has got somewhat larger, such that, you know, the the amount, the proportion of debt relative to your valuation, your equity valuation, and your enterprise value is small enough. So that's kind of traditional venture debt. Now, obviously, we've got all these kind of increasing facilities available with governments across Europe have made available, and I think there are some really interesting terms for some of those. You know, there's a lot, and if you haven't had a look at this, I would encourage you to have a look at some of the debt that's being made available, some of the loans that are being made available. They often offer, you know, rate suspensions for the first 12 months, payment suspensions for the first 12 months. So that can be very helpful. The interest rate's often much lower than it would be otherwise. That's also helpful. You know, but nonetheless, it is non-trivial to take on any kind of additional financing that is going to could sit above an equity investor. At the time of your next round, an equity investor will want to understand, you know, how much debt you have, obviously, because they will be sitting below it. So it is non-trivial. It's great to have the extra cash buffer, but you do need to think about the implications, you know, with regards to future equity fundraising. And you really need to have confidence that as and when that rate, you know, that you do need to start payments, that you'll have some level of visibility on your capacity to service the debt.
We have a question from, I don't know. This is the first time it's happening. I don't know. That's quite terrible, this sound. So I'm really sorry for that. So question from Nikolai. What is your view on the next trend sector after the current situation? Which tech sectors will be in the higher demand than before?
Yeah, I mean, I think, look, we're already seeing lots of this, right? But, you know, anything around all the trend that we were seeing from kind of offline to online in terms of both anything at the enterprise level, so anything that facilitates working from home, etc., is going to be accelerated, as well as just pretty much every category where there was any kind of offline to online transition happening. You know, we're going to see that accelerate. So it is a hugely exciting opportunity for those for founders and businesses that are in the right place at the right time. But I mentioned obviously that there are some categories that are primed to benefit from the first order effect of people being at home more. So be that social gaming, streaming, etc. But you know, it stands to reason that anything that really touches on kind of the distributed workforce is also going to see a huge kind of acceleration or significant acceleration in demand. They're already seeing it. And I think that the adoption curve that we'll see from some of the larger enterprise customers in particular around that transition is going to be even more acute or steep, if you will.
We have another question from Claire for the after crisis. Socially responsible investment will grow after that crisis. Will it be easier for sustainability development startup to find funds? I think it's quite interesting.
Yeah, that's a super interesting question. I think so, absolutely. I mean, there are two things that are going to happen, and you see it already, hopefully, you know, in your own communities. First of all, you know, I was asking myself, I kind of went shopping for my elderly neighbour kind of last week, and I thought to myself, you know, why have I never done this before? There's a kind of totally renewed sense of community and local community that's being forced on us is the wrong term, but it's, you know, it's a good thing, and I think people are going to really reevaluate the level of social responsibility they have. I think we're doing it already. You know, I think with that, I am kind of cautious about making sweeping statements about how different everything will look when we come back to a kind of normal modus operandi, because it's easy when we're in this kind of environment to assume, to kind of have framing bias, so to speak. Everything is so different now that everything will continue to be so different. So I'm cautious of saying that, but I do think that it's kind of reawakened a real kind of focus on social responsibility. Now, the separate question is whether or not that will feed into investors who have not historically invested in this category wanting to invest in this category. You know, and it's kind of, as you know, there's always been a little bit of a division among funds that do kind of double bottom line investing, so to speak, but socially responsible investing in those that haven't. You know, I think what we will certainly see a lot more of, and we've been talking about it a lot internally, is in wanting to work with founders who take that responsibility seriously, who want to do, you know, I'm not going to kind of whitewash it, so to speak, who only want to do good, but for whom doing good and being socially responsible is also a key part of their as much culture as anything else, you know, separately to whether or not the business itself is uniquely focused on sustainable development. But I think this idea of sustainable capitalism and sustainable development, you know, will necessarily feed into the ether. It already is, which is good.
So we have a question from Jacob now. Laura, do you expect larger syndicates by VCs to still close Series B, C rounds and to diversify the risk even more?
Larger syndicates by VCs. Yeah, I mean, that's an interesting question. It may be the case that that may happen. Yeah, I haven't seen it. I haven't seen a significant uptick in that yet, but it may be that those investors that feel that they need to reallocate a little bit more to existing portfolio companies, but want to keep making new investments, may have to do that, or may look to do that in syndicates or kind of more atomized funding rounds. So it's possible. I don't know that it's a question of diversifying the risk as much as, you know, I think if you think about the kind of risk profile that a lot of VCs have, the risk appetite that they have at the early stage is pretty high, right? You know, I think in this environment, we will be less likely to do, maybe perhaps less likely to make investments that we consider to have like hugely binary outcomes, you know, but I don't think it's so much about diversifying risk as it will be, you know, making sure that there's a way to get into the best opportunities, the best businesses, whether or not we've got the capacity to write a full check. We're in a good position to do that, but other funds may not be.
Okay, thank you. We have another question from Abhishek from New York. How can I, as a first-time manager or GP, make my clean tech funds more attractive to LPs? Which LPs could be less impacted by COVID and should be prioritized?
Yeah, thanks for that question. I think it's a really good opportunity for me to segue into one of the kind of the dark arts of fundraising in venture, and you know, the financing supply chain, as it were, which, you know, you might not be as familiar with if you've not been on the investing side. What I mean by that is, and you've seen lots of conversations about this, I'm sure, is that, you know, every venture fund has at least one limited partner. So that means, you know, has at least one investor in the fund, and most funds will have many more than that. You know, obviously corporate venture funds have for the most part what the corporate as the kind of main, what we would call the kind of main LP. But I think, you know, again, so what usually tends to happen when venture funds invest, and it's helpful to just give founders the clarity on that, is, you know, we'll make the investment, that is, we will offer the term sheet, and then we'll kind of close the investment, as it were. But we have to issue, we being the venture fund, have to issue a capital call to our underlying investors. That is, you know, we don't have the capital, as it were, sitting in an account somewhere that we can just disperse at will. We always keep some kind of buffer. But when we make a new investment, we have to ask the underlying investors to essentially wire us the funds. And what you may have seen already in the news is that some venture funds who want to continue to invest have seen, when they've made a capital call, or indeed even before making it, when they're in conversations with LPs, their underlying investors, the underlying investor will say something like, look, I'm not very comfortable making any further investments. I don't really want to meet a capital call. That is, I don't want you to ask me to wire the funds over, because I'm not sure that I, you know, will be able to do that, or want to do that at this point for whatever reason. And I'll go into those to answer your question, Abhishek, specifically. And so as a result of that, there is already some news about LPs defaulting on capital calls. That is, a venture fund asking them to send the cash required for a new investment, and LPs refusing to do that. Now, that's highly unusual. I don't expect it's going to pick up, but just so you understand the kind of supply chain of financing, that can often, you know, that's what the process looks like. So it's not as simple as, today I want to invest, I've got the money in the account, it's coming straight over. Now, so to answer your question, Abhishek, about if you're fundraising, you know, for a clean tech fund, what kind of LPs should you be looking at? You know, I think in a way, you should put the same hat on that I was suggesting founders put on at the beginning. When you think about rank ordering the investors and the larger kind of fund of funds, or whoever that will be still actively investing. Think about what is their likely liquid exposure, what kind of appetite have they exhibited beforehand. If they're a fund of funds, for argument's sake, that actively invests but has a very large public allocation, which a lot of them will do, then it may be that they're going to slow down their illiquid allocations. In particular, they may choose to reallocate to existing strategies and people they know versus those they don't. But there will be lots of opportunities also with larger potential investors who now also have an allocation for ESG, so anything to do with clean tech, for instance, who are really keen to put their capital to work as part of their kind of just general governance procedure and kind of allocations, target allocations. So, essentially you need to go through every LP with the same hat that you would do as a founder trying to select an investor.
So we have still 10 minutes, so perhaps a quick answer for Yassine and Jawad about Balderton investment in France and outside Europe, especially MENA. Are you investing in France? Yeah.
Yes, absolutely. We're very active in France. In fact, we've got 2 members of the team who are out there full time. So absolutely, we are very much so. We're always looking in France. So our 2 team, we've got a principal and an associate there who are based in Paris. So yes, don't hesitate to reach out. We invest across Europe.
Across Europe and not outside. In MENA?
Oh, sorry. Yeah, in MENA. No, so we really only do European founded businesses. So in practice, that's really Europe rather than MENA at this point. But I know there are some great businesses coming out of there, so that may change.
And the last question coming from someone anonymous, perhaps a candidate. Are VCs still hiring? Yes.
Yep. Absolutely. I think we are. I think the opportunity set for roles in VC is often spiky. So it's not the case like some of the larger corporates. We don't have a kind of ongoing program that we seek to hire people into, but we are always looking for smart people. So as and when there's a kind of gap in the team that we need to hire for, it's good to build a relationship ahead of time and get to know people. So yeah, we are. I think a lot of VCs are still looking.
Okay, so you can send your resume to Laura if you want. You can share with us and we will do the job for you. So do you know any VCs investing in the well-being sector? Are low-tech startups focusing on well-being interesting for VC investment? Question coming from Christiana.
Yeah, I mean, I don't exactly know. I'm not entirely sure what you mean by kind of lower tech startups, but yeah, I mean, well-being and wellness is online well-being, wellness, anything to do with consumer-facing apps that do that in an intelligent manner are always interesting. We've invested in several wellness apps, including LifeSum, which is a health and nutrition app based in Stockholm. So yes, I think absolutely that will continue to be a really interesting space. Look, all the more so now that we're all holed up at home and eating twice our weight in food, probably. Yes, I think it will absolutely be an area of interest continuing. Yeah.
And perhaps last question for me before ending the session. We talked yesterday about the high standard of leadership the founders need to have in this time. We need to announce perhaps a massive layoff, communicate with employees. What is the best soft skills we can have, and is that an opportunity for female founders perhaps?
Yeah, no, it's a good question. It's so interesting that because we have found that we're a team of about 40 people ourselves, and we've obviously moved to be a kind of completely distributed workforce over the last 3 weeks. And the thing that some of you will already be doing that, and for the most part we work in a very autonomous fashion. But I think what we've really had to be very thoughtful about is making sure that we're over communicating, and so trying to replicate some of the kind of water cooler dynamics that we have in the office. So what I mean by that is, we've now set up 2 times twice weekly calls in different randomized groups, so different people kind of keep chatting to each other, again kind of, as I said, replicating the water cooler dynamics. So over communication is absolutely key. identifying those people who work with you who are working by themselves, or who are under or caring for someone, or be it children or elderly parents, etc. You know, I think it's also critical in making sure that those people feel supported is really essential. You know, I think this is a really good moment to practice kind of communication just generally, and I was going to say EQ. You know, some of the other things, just to make that concrete, that we put in place are kind of weekly town halls. You know, we're spending a lot more time thinking about not leaving anyone out in the cold, as it were. Now, you know, I think the classic trope is that women have higher EQ than men, and I think that I've seen men with very high EQ and women with exceptionally high EQ, and the reverse also true. But I think what is certainly true is that for anyone who kind of has that as a core skill, you know, this would be a really good time to be putting it to use, and be a thought leader in that, and provide guidance to people around you. You know, I think the final thing about the kind of the leadership point is that, you know, I think it's easy to forget how psychologically draining this kind of an environment can be. You know, you think that if you work hard, and I'm guilty of this, if you work really exceptionally hard, and you know, not like we've got a huge amount of time to do anything else, that you know, that you kind of forget how easy it is to get actually kind of very latently stressed with being confined. But you know, self-care in this environment is as important as kind of communication and you know, leadership, and encouraging other people to self-care properly in your team is also critical.
I will take, sorry, for the last anonymous question. The last question come from Gideon. What do you expect to happen to valuation? I know one of my angel investment had to discount a little to close Series A. Where will they settle down compared to pre-COVID? Will it vary across sector, fintech, ad tech, data tech?
Yeah,
just a short answer, because we need to end like in like 2 minutes.
All right, short answer, Gideon. The short answer is, and I think the general point about valuation at the early stage is that, you know, what we're not solving for here is, you know, getting a 10% or 20% or 30% higher or lower valuation. You know, as investors, the point here is that if we invest in a business that we really think is worth doing, that we're aiming for kind of returns that will return the fund. So whether or not we get in a kind of 10 or 20% discount or premium at the beginning, frankly, is somewhat irrelevant. We're not trying to time the market as venture investors, and I think that's a really critical point here. As early venture investors, that's not the point. However, you know, what is absolutely true is that we have to make defensible investments, if you will. From an LP perspective, as well as, you know, just I suppose common sense, really. It has to be the case that you know, often some of the competitors and the way we think about valuation will be somewhat dictated by exogenous factors. The market conditions is one of them. It's not the whole story, but it is part of the story. So what I expect to see in valuations is likely there will be, and we're already seeing it, right? There will be some downward pressure. That is absolutely, that's just will necessarily probably happen, but you know, that's not what we're trying to time, so to speak, as early investors. Now, to your second point about whether or not there are sectors that are going to be more impacted than others, yes, absolutely, and the reason being is that if the market and market valuations are part of the story, then those sectors that are more kind of more pro-cyclical and are going to be more greatly impacted in this environment, then it's likely that those sectors may see more variation. Now, that being said, those incumbents that are going to be more highly impacted, like large fintech, etc., may also find that this is a huge opportunity for great startups. So, you know, there are kind of countervailing effects here. So it's not as clear cut as, you know, the markets come off, therefore all valuations are going to come off massively. But obviously it's part of the story.
So thank you so much for the end. Thank you so much, Laura, for being with us today. Thank you to all participants for joining us. You will receive tomorrow a feedback survey. Please send us your needs and idea and your feedback on the session. Just to tell you, we will have another session with a business angel for perhaps pre-seed, seed startup in 2 weeks with Deepali Nangia, and perhaps a French business angel too. And next Thursday, we will talk about tips to successfully manage remote teams. We have a lot of questions about that with Pamela Cordu-Aubin. She's employer branding director at Doctolib and ex-EMEA marketing director at GitHub, you know, a fully distributed company. I think it's quite important to talk about that too. Thank you so much, Laura. And you are on the platform, so people can ask you questions at the end of the Ask Me presentation, and you can answer directly in the comments if you want. Because I see that you have 2 questions more, so sorry for that. I didn't pick it because we didn't have time anymore. We have an engagement with Laura. Thank you so much, and bye-bye.
Thanks, bye.